Hey, Christian. So nice to have you here. A quick introduction. Christian is one of the main portfolio managers on BNP Paribas, focusing on the technology strategies. We were just talking backstage, and he said it's like you worked in consultancy for biotech back in the day. So a very niche market and a big expert in his market with more than 20 years of experience covering technology. We'll go through 3 different strategies during our presentation, and Christian will show you some slides on those topics. And we'll start with technology, markets, AI, these major macro trends that we are currently seeing. Then we will run into the investment strategy that you guys do at BNP Paribas. And then Chris will be so nice to show us some case studies on examples on how they apply those strategies. And you guys will go home to a couple of investment ideas that you can apply. But the best way to do it is probably through BNP's fund, right? So there you'll have access to all the strategies. Christian, let's begin with technology, which is definitely a central theme, not only of the presentation, but markets in general today, right? I think it's probably the hottest topic we are seeing in equity markets. So I know that you have things to show here. I will start with, how do you assess the current stage of AI adoption across enterprises into 2025, and how is that going to impact the markets going forward and your strategy of allocation going forward?
Thank you. This is one of the biggest questions we get from all of our clients across the US and across the world. It's just one of the most impactful sectors that has been in a very long time, and you've seen that in how concentrated the stock market in the US has been with technology stocks and technology performance. It's just been amazing. If I go just to show you over time here, this is the 4 major indices that we look at. We look at the NASDAQ, which is mostly technology companies, the large cap growth benchmark, which is the Russell 1000. You can see over 10 years, they have traded in line with each other, that are up 440% over the last 10 years. It's not a lot of asset classes, generally speaking, that can be up that much, and it's driven primarily by technology. That's why I put them together, to show you that they've been in lockstep together. Currently, technology is about 53% of the Russell growth benchmark, and then if you add in the rest of the Mag 7, Google, Meta, Amazon, and Tesla, it brings you to 65%. So technology plus the Mag 7 is 65% of the large cap growth benchmarks, and they've just been dominated by. I've watched a lot of the speakers talk about the Mag 7. This has been dominated by that, and in recent years, dominated by AI. Now the other indices on there are the S&P 500, which is up 300, a mere 300, which is pretty good. It's also driven a lot by the technology space. And the smaller one at the bottom, which is the small cap benchmark, which is still, it's no slouch. It's up, 175% over the last 10 years. It's pretty good. But technology is a huge component of that. And we spend a lot of our time analyzing new technology. I'm not on the tech team myself. I'm more of a biotech and healthcare portfolio manager, but we have a tech team that has 25 to 30 years of experience, actually worked at tech companies in the past that analyze these companies for us. They actually run a disruptive technology fund, which is $6 billion with tremendous performance over the last 5 years, driven by these names. And so they get in the weeds analyzing these companies, analyzing the AI, and they tell me, to make sure I tell everybody here, this is just in its infancy. It's just getting started for the first time. It's been around for 20 years, but nobody, it wasn't around for 20 years for the rest of us, and around for businesses to use, and it is now. So it's impacting every company, in not every company, but most companies in every different sector are utilizing AI now on a daily basis, and it's just been tremendous here.
That's a great point, because you mentioned the fact that we're basically still in the early innings, right, of what could be a wave of disruption within this world of AI adoption and how technology could impact. What do you think are the things that maybe could accelerate that?
Yeah.
Or to put it on the other side, what could hold it back?
Yeah. Well, let's start with the accelerate. Obviously, there was a shock to the system earlier in the year when DeepSeek, came out from China, and it just shocked with the price of doing AI. And it's actually most likely a very good thing, for the market. There's something called Jevons paradox, which our tech team talks about, is when something is very expensive, a technology, its use is limited. When the price comes down, its use skyrockets up. And we'll get to a slide later about that. But currently, most businesses or most people in the audience might use ChatGPT. They might ask questions. It takes the place of Google or something like that. But it's being used in companies much differently. And we're just starting to see the benefits of that. We'll have examples later in the presentation about where specifically it's being used in areas of healthcare, in areas of financial services, outside of the traditional technology and software sectors, which you always hear about.
So let's go into that, and maybe you can use your slides and jump around if you want. Which are, let's say, the sectors, enterprises, parts of the economy that are better positioned to benefit from that AI disruption?
Yeah.
And then if you can discriminate maybe a little bit between different sectors of, let's say we have like the hyperscalers that are the ones that are really investing. Then you have like the picks and shovels guys, right? Like NVIDIA or ASML, the ones that have the tools to deploy that. And then you have like these second derivative guys that can benefit from a lot of different ways. So if you can go into that, and I know you have some slides that show that, and then just for you to use your presentation, because I know you touch into that, in terms of the profitability of that adoption, right? Because a lot of people are making questions. These companies are spending like 50 billion, 100 billion.
Crazy amounts of money on this.
In AI, so it's like, how profitable will that be, and how will they be able to capture that?
Yeah, all right, good. There's a lot there. So I'll kind of start, your first question was, what types of companies could benefit from AI? And the answer is, right off the bat, any company that has a large data, that collect data, whether it's in the financial services like an insurance company or Allianz or somebody who tracks data over time. In the healthcare sector, companies that we'll talk about later that track patient data or clinical trial data, and they compile large amounts, and it's very hard to analyze. But you can use AI to analyze it almost instantaneously, whereas it would have taken 3 months, you can do it in 1 week or less now. So, and this goes obviously for the software, services, and obviously some industrials companies are using this, and so it really touches all of our sectors. And just to show you on these valuations and profitability here, if you look at how well the technology sector is done, people's obvious question is, well, it must be overvalued. It must be the PE multiples are too high. How could it possibly continue? I remember having this discussion about NVIDIA 3 years ago. They were saying, well, how could it double again? And it's quadrupled since then. So that's not the right question. The question isn't, what is the current valuation? It's what is its relative valuation versus itself, and where could that go? And then you look at what's its valuation versus its peers. And when you actually peel back the onion there, they aren't that expensive because the revenue growth and the profitability of these companies is astounding. And this chart shows that. If you look at the PE, which is it's the gray line, 20 times. Is that egregious for a company that's growing immensely and basically changing the world? I don't think it's outrageous. And then you look at the profit margins; they're just going up, up, up. And the left side of the chart is the Russell growth, which is the U.S. growth benchmark. And then if you look at the ROE, they're still returning a really high ROE. So like, what's wrong? They think the multiples are cheap, the ROE is high, and the profit margins are continuing to go up. And conversely, if you look at the MSCI index, world index outside of the U.S., I mean, they can't even compete. I mean, we're talking 10% versus 25%. So the answer is, for now, until something changes, the profitability of these companies is there. And the relative expensiveness is not overdone. And they've quadrupled and been up, whatever, 1,000% for NVIDIA. And we think there's areas of that index that can still do those things.
I love when you compared like multiple of PE versus margins and profitability, because what immediately popped up in my mind was like Walmart, which is trading at similar multiples,
right,
but has like 5% or 4% margins, right?
I mean, that's right.
And these guys have like 80% margins.
You look at like some of the consumer staples companies, which we don't really invest in because we don't find them innovative. Yes, they're cheap, but cheap for a reason. And sometimes when there's a lot of noise in the US with Trump and all the things that are going on in the world, you just take a step back and think what's really going to happen in the longer run is probably a more positive scenario than is currently being baked in. I think the market's actually starting to see that. So some of those staples names which people flocked to for safety and stability isn't paying off because they're actually trading at higher multiples with a minuscule growth rate compared to that. And there's just less innovation and there's no disruption in those areas. So that's kind of what we look for.
I see next slide there, and it discusses a little bit the opportunities. So I want you to touch on that and go a little bit on the opportunities and the risks that we are seeing from this point of view. And then I will go back to pull something about the volatility and the uncertainty that we have in the market right now.
I mean, so there's obviously a lot of opportunity when you consider where we are in the cycle. We're just starting off maybe inning 1 or 2 of a 9-inning game for the baseball reference.
That's a tough reference for Brazil.
Tough for him for that one.
And we are at the first 10 minutes of the football match. Let's put it that way.
There you go. Yeah. But the themes are cloud computing, AI, Internet of Things, automation. These touch all sectors. So it's just the opportunity is immense, and the amount of money that these companies are making, and then in subsequent slides you'll see how much they're spending, which has been a controversy because they're spending so much money right now. The thought is, well, how could they possibly spend this much money going forward? And the answer is, we don't really know. In 2025, we still think the CapEx expenditures are going to remain growing or maybe tapering off a little bit, but you don't really know what the future brings. But the amount of money they're spending is larger than the small cap index. And it's just astounding. So we're just in such early stages here. One of the things that we do bottoms up research, and part of that is getting into the balance sheets of these companies and doing DCFs and really figuring out how we value them. We don't just look at a multiple because a multiple is a very near-term, sentiment-driven item. We'll do DCFs and reverse DCFs to figure out what's baked in. And we look at all of our technology stocks and we graph them out of upside just based on our DCF and our price targets, and there's still huge upside, 20 to 50% in a lot of these big tech companies still. Now, the sell side may or may not agree. We don't really care what they do. We do our own research, and we see just tremendous upsides to stock prices and DCFs kind of going forward.
Just to put everyone in the same page, DCF is discounted cash flow.
Discounted
so basically,
cash flow.
You bring to present value all the future cash flows.
That's
when
right.
you do your deep research analysis. And to go into the risks?
Yeah, and just quickly on the DCF, we realize you can make a DCF, spit out any price target you want to spit out. We spend a lot of time thinking about the 3 drivers of the DCF. The first driver is your revenue projections and profitability. We don't look out 1 or 2 years. We look out 10 years and try to figure out what the environment's going to look like in 10 years, what's the competition going to look like, what's the profitability going to look like. And so that's where we do our own modeling. We figure that out. Then you look at, okay, what's the WACC, the weighted average cost of capital, what's the interest rates look like. Spend a lot of time thinking about that. We don't use the Bloomberg or the FactSet WACC. We do our own WACC calculations based on what we know of being sector experts over the last 20 years. And I may use a WACC of 10 for Eli Lilly, or I might use a WACC of 20 for a small cap company. And then the third piece is the terminal value. We don't want a terminal value that's just like 5% for eternity, because that's just not likely to happen. So what we actually do is, if we model out our company's 10 years, which we try to do, we'll give a terminal value of maybe 1% or 0%. In certain sectors like healthcare, we'll do a negative terminal value because drugs come off patent, competition comes, things like that. So we're very cognizant of that and spend a lot of time focusing there.
Before we go in deeper back into your investment strategy because I really want to dig in on that one. I see that here on the risks, you mentioned the policy uncertainty that could continue. So I want to tap a little bit on that one. It's like, given the policy uncertainty and geopolitical risks that we are seeing right now and that you mentioned here on the presentation, how is BNP Paribas positioning its portfolios today for that level of uncertainty, the increased volatility that we have seen in markets as well?
So that's a good question. This is one that our bosses ask us all the time. And the answer that we give and what we believe in is that we really don't structure their portfolios from a top-down basis. We don't let certain uncertainties and certain presidents and certain administrations dominate how we invest. We do bottoms-up research. We focus on catalysts and valuation. Yes, if interest rates are staying up longer, there's some balance sheet risk for our companies. If inflation stays higher, there's some risks to our companies. But we're modeling for that all the time. And so we really don't sit there and say, is Trump's big, beautiful bill going to be passed? Are interest rates coming down this year? Are there 2? Are there 3? Are there 4? We don't know, and we're not going to make a bet on that, and we certainly aren't going to structure our portfolios kind of based on those things. Now, we will, from an individual level, stock level, say, okay, where do you produce your products? If you're selling in Europe, are you producing in Europe? That avoids tariffs. If you're selling in the U.S., are you producing in the U.S.? That avoids tariffs. And so if that's not the case, we try to quantify, well, what is the risk? But we're not selling a stock or buying a stock because of those types of things. It doesn't work, and you're wrong because the next day there's a different tweet, and things go the other way. And so investing that way is just not part of our ethos.
That's great because it's something that we try to pass through to our clients all the time, which is separating noise from what actual matters, right?
Yeah.
And when you are an individual investor, that's usually the most difficult part, right? Because you understand that you have to position yourself for the long run.
Right.
You have your diversified portfolio, you have your equities, you have your fixed income, but then the noise comes,
right.
And that's the difficult part to understand as an individual investor sometimes. I want you to mention a little bit before we jump in the investment strategy. You have the slide there of the potential catalysts. So what do you think are like these catalysts that can make it really go berserk?
Yeah. I'll finish on the risks and then talk about the catalysts because they're related, right? So you mentioned the political noise and the headline risk every day of tweets and threatening Brazil with 50% tariffs if they don't do something with Bolsonaro. Those things are they are noise, and they're kind of strong arm tactics that I don't think anymore the market takes into account as much. They used to. Even all those 3 months ago, they used to do that, but now you're just not seeing the impact of that. So when there is stabilization of this noise, right? So he got his bill passed. Okay, the tax rate's staying where it is for the most part. Now we got to worry about interest rates, right? He threatens the Fed chairman on a daily basis, even though he appointed him, not long ago. He's trying to get people to do things that he thinks are good, and he's not an economist. He's not a Fed chairman. So I think some of the potential catalysts are just eliminating or mollifying some of those risks and kind of getting back to a normalcy. Maybe tariffs stay longer than we thought. They did. He started tariffs in his last administration, and when Biden came in, Biden kept some of those tariffs. Some targeted tariffs are a good thing. Across the board tariffs across the entire globe is not a good thing, and I think he's realizing that. So we'll see. And then the other catalysts are looking at our companies. Every day we're looking at our companies. This is earnings season coming. It started this week and last week, and so far so good. But if we could and the economy comes out with data every month, and the data from the U.S. economy is quite resilient and quite strong. So we have counterparts in Europe who said, oh my gosh, U.S. exceptionalism is over. They're changing their ethos on everything from the Ukraine war, blah, blah, blah. We're pulling money out of the U.S. And that's kind of a knee-jerk reaction, even though you may feel that way in your gut. Take a step back and look at the fundamentals of the companies. Look at the earnings growth, look what they're doing, how they're disrupting the industries, find those profitable companies that are going to be winners. And that's kind of how we do it. So we really try so we think the strong earning growth is going to continue for not every company, but for the good companies. And as I mentioned, AI adoption is at its infancy, and that's going to drive, there's a slide coming later that just shows the more you use AI, the more profitable in the long run your company could be. And there's a slide that shows that. So, and then I think our tech team still loves the semiconductor space. There's just so much going on there. The growth there is just exponential. If you had said 5 years ago, NVIDIA and Broadcom and all these companies, Marvell and Lam Research are going to do what they've done, you'd say no way. and the reality is it's still going, and they're not particularly expensive.
That's a great bridge for us to shift into your approach on how you look to these companies, because there's a strong emphasis on fundamentals, and I love what I see here, the word resilient, right? You focus a lot on fundamentals and resilient companies.
Yeah.
So before we speak about that resilience, like how would you define resilience in that?
Yeah.
I think that's important.
So yeah, it's part, we have a slide about our philosophy, and we use the word resilient, and it often brings up, well, what do you mean by resilient? Is this an ESG thing? And it's not. It's not an ESG thing for us, even though BNP is very into the ESG integration. It just comes down to what type of company you are. Can you manage through cycles, down cycles, up cycles, inflationary cycles? And so that's what we mean by resilience. They have the balance sheet strength, the management team experience through the cycles, and then the appropriate returning into R&D and making sure that you're not just using everything now and not planning for the future. So those that put money back into their own R&D, we look for that. And it's just one of those things that we look at. And so that's how we define resilience.
Perfect. So run us a little bit through resilience on the earnings of these companies, and how these hyperscalers are just moving forward at this AI arms race that we're seeing right now.
This just goes back to what I was saying earlier, the amount of money spent from the hyperscalers in particular. This is AWS, Azure, Google Cloud, and all these other companies. It's just astounding. Like I said, the amount of money they're spending each year is I think it's, 40% of the entire S&P's CapEx. Like these companies right here are spending the CapEx that the entire S&P in the US, which is huge, are spending.
I heard something the other day which I thought was very interesting, which is the sectors that we usually understand as CapEx intensive, like pharma, that has usually a heavy pipeline of R&D and innovation, or utilities that also always have to spend CapEx. All these hyperscalers, like the largest of them, are spending much more than those two sectors combined.
That's right, and I guess that's the point. There's just that much, need for these type of products, and they're spending that much because they know or they believe they're going to get the payoff in the future too. You're just not wasting your money. So that ROE we talked about is high and staying high. That's what they're going to make sure of it. And so I think we're going to see more and more businesses use more than one type of AI for more than one type of reason, right?
That's great.
Yeah.
And there it is.
This just shows the CapEx last 12 months and how much they're spending. It's just kind of an elegant way of showing that it's still going up. It isn't going down, right? And so this is just from Microsoft, Amazon, Google, and Meta. So it really is kind of astounding here. And this is what I was referring to earlier. So it looks like a complicated chart, but just look at the left side, and you think about the functions of AI. How are people and businesses using AI to benefit themselves or their companies? And they've shown that one or more functions of AI is good, and a high percentage of people and companies are using one function of AI. We use it to search through transcripts and pull out the salient ideas for our companies. When they have to go back and listen to the full earnings report, we can use that. So we're using one function. Other companies are using 5 or more functions. And you can see on the chart on the left what the impact of these types of things are over time. So that red circle is showing you when the internet first came to be, how the same concept increased productivity for the companies. Now, it's a stretch to say AI will do the same thing, and we're not seeing it yet, but we believe it's going to do that same type of thing with productivity for companies.
So it really can be a game changer, not only to technology companies, but to the world in general, to productivity in general,
all sectors.
Right? Yeah. So it's like to the broader economy, like how much it can improve productivity. That's just a huge game changer. We touched a little bit on your investment policy, and I want you to go into this slide. We define resilience, and we define already that your approach really has this strong focus on fundamentals. You said that you really go deep, you calculate your own WACC, you calculate your own DCF. So there's this deep focus on fundamentals, this deep focus on resilience. How do you balance the innovation exposure, focusing on those fundamentals and resilience, with attractive valuations in sectors like tech and healthcare, which sometimes it's difficult to find attractive valuations?
I mean, that is the key, and that's, these Venn diagrams, merge together, and you want to try to find the small place where they overlap. But just a bit on the types of companies we look at. I mentioned we're looking for disruptive companies, innovative companies. Innovation means, looking at the IP. So for drug companies, we look at how long the patent life lasts. We look at when competition comes in. When does it go biosimilar, right? For tech companies, they also have patents. So we look at those things. And then we also look at, is it a unique product? Is it solving a problem that hasn't been solved before? Is it curing or treating a disease that hasn't been treated before? Weight loss is one of them. There was nothing. And now there's pretty good drugs out there. So that was kind of a game changer for Eli Lilly and Novo Nordisk and some others in the future. And then we look for high barriers to entry. I think everybody says they look for these things. They do. Everybody who does equity research looks for these same types of things. But we just have these experts that have been doing it for 20 to 30 years that know the management teams and know that and really get to this. What are the barriers to entry? And then so we come up with. Like I said, we come up with our price targets. We come up with, is this the type of company we're looking at? Is it a growth company? Is it a cyclical company? And cyclicality is either in favor or out of favor. Is it a turnaround story? We try to leave no stone unturned and find everything we can possibly look for to make clients money. And then at the end of the day, it comes down to valuation. So we look at our themes. Each one of our we look at healthcare, we look at oncology, we look at rare diseases. We have themes that we look at, curing disease, not just treating disease. And in tech, we look for all the things that we talked about. And then once you kind of marry the three together, we say, all right, what's the valuation look like versus itself, versus its peers? And then we try to come up with a plan for putting into the portfolios. And not every stock is right for every portfolio, but in a growth fund or a small cap fund, or a technology fund, we really look for catalysts and figure out when to put it in and how big, and not take excessive risk too early in a cycle. So we think about all those different things.
That's perfect. Yeah. I love when you speak about these companies, how we in Avenue give as an example to clients, like some of the reasons why you should invest abroad, right? And there's many of them. But one of them is like, it's the market where you can find these kind of opportunities, right? I always tell to clients, don't buy Ozempic, invest in the companies that do Ozempic, right? Yeah. Or it's like, look for, in Brazil, if you want a company that is disruptive in AI, in biotechnology, in innovation, there's not much, right? So this is the kind of markets where you really get exposure to this allocation, and here with BNP Paribas you get really experts that go deep into those kind of cases. Before going into the case studies, because I know we have two quick case studies, I just want you to do a 30-second, because you mentioned that BNP Paribas has a lot of focus on ESG. Yeah. So I want you to give a 30-second brief on, it's like, what is the role of ESG integration play in your investment strategy? Yeah.
So for us in Boston, we have 6 products. We integrate ESG into our process. It's part of our philosophy. Does that mean we're not going to buy a stock because of ESG? Not really, unless it's on the exclusion list. If it's making controversial weapons or fracking oil, we're not going to buy those. But if something has a poor ESG rating, which is a 10, just to give a number to it, we're allowed to buy it, but we have to try to engage with that management team. And we've done that a lot. Like, for example, Meta. Meta is a great stock and a very good company, but it doesn't score well. It's a 10 on the ESG schedule, on the scoring. And so people say, well, why do you own Meta? I said, well, because it's an amazing company that can only improve. I mean, they're at their worst. They can only get better. That's going to be important. And so I think the whole point of ESG is to make these companies get better. It isn't to just exclude them and say, we're never going to invest in you. So that really is, for us, it's part of our gestalt, it's part of our thinking, but it doesn't dictate how we invest per se.
Perfect.
Yeah.
Let's move into the case studies.
Yeah.
And let's give some investment ideas here to the crowd and examples on how you guys look into it. So, Toast, it's kind of a fintech for restaurant solutions. So explain the case and how you think it's a great idea.
So I went out to dinner last night with some friends, and they took me to a place that they don't use Toast, but they use a very similar device where you guys are all familiar. At the end, they come over with a little machine. You tap your card, and then you're on your way, and it's very good. And so the concept of that isn't unique. There are a lot of companies that can do that, but I think it's the way in which Toast is using AI, and they're using specifically how much better they are than others, at least in the U.S. They're just kind of dominating in terms of the restaurants. So if you think, the AI is hugely important. And what I mean by AI, how are you using AI? It's just they're compiling a lot of data. They know what you eat. They know what you tip. They have a lot of information on you, which can then guide. The data is powerful.
This is, sorry to interrupt, but this is when I mentioned in the beginning, like the second derivative plays of AI, right? It's not
this
the
is
obvious
not an AI
one.
company at all. They're not a hyperscaler. They make a device. They do Internet of Things, right? They connect your payments with the company, and they collect data, and they make it seamless, and they make it easy. And the things we look for it's just disruptive. There's not a lot of competition in the U.S. that they can compete with, and it's still growing at 20% revenues because they're so early in its adoption also. So it's not like it's saturated. I think of all the restaurants in the U.S., they have a 14% market share, which is, okay, that's a lot, but how much bigger can they get? And we think a lot bigger.
Do you see meaningful growth opportunities for them outside the restaurant space, and how does that shape the long-term view of the company?
Sure. So as of now, their focus is on restaurants. And when they start getting to a sufficient level of penetration where they're making really great money, and they are looking into other areas, grocery stores, mom and pop stores, smaller stores, bodegas, things like that. And that is the wave of the future for them. But right now, they're trying to dominate the restaurant share. At 14%, there's a lot of room to go up. And one of the things that we like about it is the usability of it and the feel of the product. Like we use Toast. I go see it. I ask them questions about Toast all the time if I'm out at a restaurant. And it's kind of a seamless thing. And so then we say, okay, that's a cool idea. How does it get into our process? And my colleague Derek covers it. He meets with the company. He talks to them. He goes and uses it. And he builds his own model. And these are his numbers here. These are his revenue projections. These are his EBIT projections. We initiated the company, the position, the portfolios when it was at $29. His price target is $50. Maybe that doesn't seem like big upside to you, but for a larger company in a competitive space, it's some good upside. And so, and he is very conservative in his modeling, and so he thinks that even if they double from 14% to 28%, it will go way past that $50 price target. It's just we don't want to get ahead of ourselves. Make sure they execute. Make sure they say they're gonna do what they say they're gonna do. And then we don't sell these companies if they get towards our price target. We reevaluate, decide if it has another leg to the story, or maybe we trim on success. The stock's up this year, and that's kind of how we manage it.
Perfect. Yeah. And this is a case on how you see like the resilience philosophy into play, right?
Yeah.
And how you put that into play in your investment strategy.
So just on this, like before we go on, this just shows on the left side the number of restaurants in the U.S. and the penetration rate. It says 13, but it's actually 14 at the end of the year. And then if you look at the untapped markets of the rest of the world. And it's just massive. And there will be consolidation of these. There's a lot of little players. I know that you have many different ones in Brazil. I asked him to tell me what they were, but I forget what they were. But there will be some consolidation. There will be some winners, and we think Toast is going to be one of those winners. On the profitability front, how it works is every time you tap your card, for every $100 you spend, Toast gets 50 cents. And so in aggregate, that's actually pretty good. That's a high take rate, they call that. So that's a pretty good take rate, considering how much people spend in the U.S. and around the world on dinners and foods. So
I wish I got 50 cents
yeah, right.
every $100 that people spend on restaurants. That's great.
Yeah.
Case study number 2, I read them. And this is right up your alley, right? Your biotechnology.
This is. I'll skip some of these slides and we'll get back to them. That was about M&A. But iRhythm, so this is near and dear to my heart because I'm a kind of a science geek a little bit. I have a few master's degrees in science, and so I've actually used this product. But what it is, it's a wearable patch that sticks right here on your chest. No wires. And if you have a potential cardiac issue, whether you have an arrhythmia, you have atrial fibrillation, you have some kind of ventricular arrhythmia, or you just had a stroke or you had a cardiac procedure, they'll send you one of these wireless patches that you wear, and you wear it for up to 1 week to 2 weeks. And it records every single piece of cardiac data that happens, so every heartbeat. And you can imagine every heartbeat for 2 weeks. There's a lot of heartbeats there, and there's a lot of analyzing of data that needs to happen. And they use AI as well. So this is a perfect example of how AI is impacting and benefiting healthcare companies. So, this one is just amazing. So it's our belief that eventually when you go to a hospital, you check into a hospital, they're going to, instead of putting the pulse ox on your finger, doing the blood, the blood pressure cuff, they're going to use a patch like this that does all of those things in one.
This is close to home to me as well because when I was 19 years old, I had a heart surgery. And for them to discover what I had to do a Holter.
Yeah, a Holter. And you see how terrible it was.
And I had this huge machine the size of a smartphone on my hip for 1 week. Lots of cables.
Wires.
My skin was already all itchy due to the glue of all the cables and everything that I had. So that's a great one for us to see.
Yeah.
And what are you seeing for them in the future? And how big is it in your portfolio?
So right now there's 2 products. If you think about your Holter monitor, you weren't an extremely high-risk patient, so you could have this Holter monitor that just records the data and doesn't send it in real time to your physician. You don't need that. So right now they have that product where it just records data and then at the end of the 2 weeks sends it to the company and they analyze it and send it to physician. That's one, and they're penetrating very highly there. They have like an 80% market share. The other piece of it is called telemetry, where you wear this device. You're maybe a higher risk patient, you had surgery recently, you have an arrhythmia, and it communicates with your physician and the company in real time. And it has a button on it that if you feel a symptom, you can push it. And then on your phone, you can say, I felt dizzy, I felt a palpitation, whatever it was, you say it. And then that helps the physician, and when the people are reading the results, to say, okay, this was not, this is the arrhythmia that this person felt. And so that is a huge untapped piece of the market because this just got approval or is getting approval for that part of the market. And, to do it wirelessly for 2 weeks, the battery size, which they've gotten down to, you can see the picture there, it's very small. And so to have it kind of wearable for 2 weeks with no battery, that you can use your own phone with. You carry your phone with you. You don't have to wear a big Holter with wires. And then in real time, it can communicate with your doctor, and they can tell you, you need to go to the ER, or you're good. You just had a PVC or whatever it was that you had. And so it's just kind of and I've used it, and it is very easy, and it's seamless. A lot like Toast, it's seamless with your phone, and it can give you a lot of information. And they're still growing, 20% a year. And this is a smaller cap company, right? So you can see here, The stock price this year, on the right side, the stock price is, at the time I made the presentation a couple of days ago, it was up 57% year to date. This is a small cap company, medical technology company, that's just really it's just kind of getting started for us. So we think it could be an acquisition target. If you look back over the years, and I've covered other companies that were similar to it, they've all been acquired by other big companies, Boston Scientific, Medtronic, J&J, all those types of larger players that don't play in this space. We think this is one of those companies that could, aside from being a really great standalone company, which we're very close to the management team, we're a top 10 holder, and we talk to the management team, and even the board of directors we talk to on a yearly basis. We just think it's just a really great one. And then on the left side, you can see what I was saying before, the penetration rates for the two products. Maybe it's 70% penetrated on the non-real-time market, and it's only 10% penetrated on the other side, which is the huge opportunity for this company.
That's great.
Yeah.
Chris, our time's up, unfortunately, but I think that in these two case studies, you really gave two excellent examples on how you guys use your expertise, your knowledge, and going deep into technology. I'm sure that none of you would have found either Toast or iRhythm in your investment allocations. So that's why you need experts. That's why you need to have the asset managers to sometimes do it for you and find the best opportunities. It was a pleasure to have you here. Thank you so much for the chat. It's a pleasure to have BNP Paribas as a partner here with us as well. Thank you very much.
Thank you very much.
Obrigado.